Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's October 1st at 8:10 a.m., the first day of the final quarter of the year. This is summarizing the note we released last night titled Labor Market Update. Typically would call it a payroll preview, but given the government shutdown and the likelihood we will not be getting the payroll report on Friday, we just decided to title it a Labor Market Update. The main themes running through the report is that demand is weak. What's particularly alarming to us is that churn or turnover in the labor market has collapsed. For a time, it looked like it was stabilizing, but yesterday's JOLTS report that showed the hiring rate and quits rate going back to the cycle lows dragged our broadest measure of labor market churn, worker reallocation, down to a new low and back to levels that it was at in the first quarter of 2013 when the unemployment rate averaged 7.7%. So that's a big issue for us. And then the final issue is that we think that the labor market is very much at risk. And this risk is much bigger than the inflation risk. The Federal Reserve is wrong in aggregate, with the exception of Moran and Waller to a lesser extent, Bowman as well. But let's just go through some of the elements of it. First of all, let's start with ADP, which is out or came out after we released the note. And they did their annual re-benchmarking, and they called it, based upon having QCEW data all the way through the end of last year. It marked down small business employment in particular. That has now been negative 4 of the 5 months since Liberation Day, starting in May, in essence. This has been one of our major themes since 2022. Some have called it a K-shaped monetary policy, the idea being that the Fed eased primarily through their balance sheet and tightened primarily using rate policy, which put the vast majority of the burden on floating rate borrowers, small banks, small businesses, households that live paycheck to paycheck, while those that own assets at the household level or are able to finance out the curve have continued to benefit from the vol and rate suppression of the Fed's balance sheet. This was just a wrong-headed approach to policy tightening. And the chickens are very much coming home to roost, exacerbated by the lack of flexibility small businesses have to deal with the administration's trade policy. So that has been a major concern of ours. There's a very weak foundation to the labor market, and ADP's number was, to me, another 2x4 across the FOMC's forehead, just like the annual benchmark revision and the big negative revisions to payrolls, the July payroll report. So things we worked through in the note, we began with the Conference Board labor differential, which took another leg lower. That's down to levels it was at in 2017 when the unemployment rate was 4.6, 4.7%. It projects to a 4.65 unemployment rate and an 8.5% underemployment rate. We think we're headed towards triggering the SOM rule again this go around, as opposed to last year where there was an element of supply. This go around, the supply's been contracting, and so demand is clearly weakening much faster than supply is falling. That idea that we had a stable unemployment rate is just kind of goofy. It's up 0.3, and we think it's going up more, but the underemployment rate is up from 7.5 to 8.1 this year. So the labor market is not in a curious kind of balance. It is decidedly weaker. Demand is decidedly weaker than supply. So that's sort of issue number one. That was also demonstrated by the vacancies to unemployment ratio. Yes, job openings were stable yesterday. However, if you adjust those openings for the very curious outperformance of small business openings, which are only down some 8% compared to large business openings being down 18%, because the BLS uses the birth death model to estimate those openings as well, and assume they fell as much as large business openings, that UV ratio is more like 0.83. That is, again, underscoring that there is excess supply in the labor market. Demand is falling faster. So the hiring and quits ratios, as I mentioned, are down to cycle lows, which brings us to the whole argument about dynamism. Just before we go there, we did include our chart of employment growth, which shows adjusted for the first estimate of the annual benchmark revision and extrapolating that overestimation of 79,000 jobs per month through August, which is actually probably a conservative estimate because, by all accounts, demand for labor got weaker after the Trump tariff shock. We're now down to 43 basis point annualized growth for private sector employment. Actually, 25, excuse me. That is decidedly weak. That's recessionary levels for the labor market. We've never gotten to this level and not then plunged into a recession. Still not our forecast because we do think the Fed will cut 100 basis points and that'll stabilize the small business sector, but it can't happen soon enough. So onto this dynamism concept. It's something we talk about a lot. We think it's a little bit of a unique aspect of our work. The origins of it was a paper presented by Stephen Davis and John Halterwanger at the Jackson Hole Symposium in 2013. They came up with a measure called reallocation, which is the quarterly sum of all hiring and separations as a percent of the labor force. You can see it in the note. It's plunged. It's down to 21.6%. We had the great reallocation from mid-21 through mid-22 when the pandemic created an opportunity for workers to change jobs within industry, change industries altogether. It then fell sharply after the reopening, but it's continued to plunge because of the way the Fed conducted monetary policy. And you can see that in the table we provided, which shows industries, cyclical industries with a large portion of small businesses have seen their reallocation or turnover, churn, absolutely collapse. So as the authors of that paper indicated, it's a big driver of productivity and real wage growth over time. And the Fed has really damaged the labor market by the way they tighten policy. So we sort of wrapped a lot of this up with the regional Fed surveys that showed particularly concerning was the services sector, current employment, hours worked, and expected employment all fell. This has been a key theme of ours about trade policy, which is given the contraction of government spending, given tight monetary policy, there is no ability to pass prices through. So if you jack a price up on some good, it impairs services demand. And that is clearly evident in these surveys. We also saw just now, we got the years of manufacturing employment index, which is bounced a little bit, but it's at 45, which is deep into contraction zone. We'll get services later in the week. New orders are weak, and that was true in the ISM manufacturing survey this morning. Capital investment 6-month forward plans are weak despite the passage of the One Big Beautiful Bill Act. We've got an economy that's in a precarious spot, and the Fed needs to respond. And that's the point about high risk. When you look at the Fed's favorite models, the Phillips curve, which relates wage growth to unemployment, or the Beveridge curve, which relates job openings to unemployment, they're both at the maximum point of negative convexity, meaning any further diminution of demand would lead to a nonlinear or really fast increase in the unemployment rate. So the Fed really needs to act here. And this idea that they don't get data, I think I saw on Twitter, Goolsbee may have intimated that in a Fox interview, that they may not be able to cut because they don't have the data. That is complete, absolute bullshit, excuse my language. They should definitively be cutting, particularly in the absence of that data. But given everything else we know, the Fed should be cutting rates here and likely will. That's clearly where the market's at. So that's it for me. We'll get our regular note out on Saturday, though likely without a big review of Friday's payroll report, unless the Dems cave here. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.